now is this absolutely fascinating time in finance, and it might be something that defines a person's career. It might be a very special moment because I mean, there's virtually no area of financial services and market infrastructure that's going to go untouched with digital assets and the transformation that's happening now.
What we have at the moment is the capacity for innovation to lower costs, and what we know from history is that when innovation lowers costs, what happens to volumes? Volumes go up, and when volumes go up, prices get finer and investor opportunities multiply.
Our strategic partners are working exactly on those problems to allow them to take their balance sheet and make it liquid and effectively better manage their risk. So these things are quite real, quite near term.
How do we transform the market? How do we ensure that an investor, also a retail investor, has enough data and enough confidence to invest into, let's say, into a simple bank loan and directly invest into a kind of local economy, yeah, and profit from a simpler process which is driven by innovation.
If you don't kind of wake up, at least tune in a little bit this year, you're going to miss out. Come work out what's real for you, because there's so much in here. As Tom mentioned, it doesn't have to be a really big thing. It could be one little consultation paper.
Welcome to RegCast.
RegCast. Shining a light on challenges and opportunities for digital compliance.
Good. Well, hello, everybody. Welcome to RegCast. This is PJ, CEO and founder of JWG, and I'm really pleased to have the 4th episode of season 2 already this year. There are a ton of developments in the digital asset arena, and we're looking to prepare ourselves in the audience for what's coming up with our RegTech event on the 5th of April. Subject today is the digital assets and the risk management equation. And I think there's a lot here we have to kind of quickly unpick before we get to our excellent panelists. We now have Europe, the UK, and the US all working on their policies in parallel. There's a lot of movement in this space. A lot of it gets down to, well, what can we do, but what's right to do for the system, and how do we monitor risk? RegTech really offers hope for lots of different types of controls on the blockchain, but there are lots of catches. We need to look at how do you program compliance into the chain? How do you introduce a whole new set of rails next to traditional finance rails? And how do you link those two different types of businesses together? And in recent reports, like the one that the great SIFMA report that had the BCG and Clifford Chance looking at wholesale CBDCs, really showed there's a tremendous opportunity here if we can get this right. We're talking about faster payments. We're talking about 24/7 availability, settlement, less costly cross-border optimization of capital and funding. All kinds of good stuff can come off the back of this. So in the run-up to our series, we're inviting some of the key players in this space to kind of talk about what they have learned and what they think it means to the sector. I'm going to ask them all to do a quick introduction to get started. Tom, why don't you kick off, please?
Hi, I'm Tom Schack. I'm the Chief Innovation Officer for Swift, and thanks for having me today.
Thank you. Peter.
Hi, I'm Peter Randall. I've been in finance for a long time, and it's great to be here, PJ.
Glad to have you on board, Mr. Chairman. And Alex.
Yeah, hi, Alex Dorfman, Product Manager for Six Financial Information. Thank you.
Great to have you here. And Dan.
Dan Doney, the CEO and founder of Securrency, a blockchain-based financial service infrastructure company.
Thank you, guys. This is a fantastic lineup. I think the first question we wanted to get to was really, how does RegTech help overcome the top risks which are presented by digital assets? So if we can unpack a bit for the audience, where do we start with the risk equation and what matters? Tom, I wanted to come to you around your experience in the financial market infrastructure and payment space, obviously. So what do you see as the key pain points there, and how does RegTech help?
Well, I think you covered part of this in the opening, in that there still needs to be a number of issues that need to be clarified in this area before we start talking about specific risks that need to be mitigated. And yeah, as you said, we're seeing good progress from a number of different regulatory bodies and people who will be overseeing these markets, which is helpful. And then when we get some clarity about how the regulators, and again, that's a pretty general term, but how these are going to be viewed and overseen, then we can go ahead and understand what regulatory frameworks they're going to apply to that, and then apply for the usefulness of the industry. So I think it's still pretty early days, but what I would also say too is that there's some things that we know that will mitigate risk immediately, and all different types of risk. One to me is interoperability with existing market infrastructure. So as you develop new services and new networks, that interoperability to what we have today is really important. Security and ID, is an obvious one, I think, for everybody on this panel and probably everybody listening to this presentation. Privacy is hugely important and needs to be treated both in terms of data governance, data privacy, data security. The standards are going to be kept really high. And then I think the other obvious one is scalability. So kind of regardless of the risks that come up to the top of the list that need to be mitigated for new services and for the safe processing of digital assets, we're going to have those four things.
Thanks, Tom. Very succinctly put, which of those things do we not have today with the TradFi rails?
I think first one's probably scalability, right? Right. There's a lot of kind of POCs and pilots that are doing kind of one-off bilateral transactions between one institution and another institution, potentially in a different country. So scalability is going to be a big deal. But I also think there's going to be a lot of work to be done on privacy, and there's kind of different standards that have evolved in Europe and the US, for example, and how privacy is treated. And what we don't want to do is kind of manage to regulatory arbitrage. Privacy is important. To give your data to a trusted organization is important, and it needs to be handled properly and with the right sense of priority.
But today, for the banking system and the market infrastructure, we handle those things pretty well, right?
I agree. Yeah, we do, and they're very those are very mature. But as these, the digital assets, and again, it's a pretty broad definition, but we're talking about new asset classes here, right? And there's lots of benefits that can come along with those asset classes, but with those asset classes will become specific risk that need to be addressed. So it's really kind of too early to tell, depending on what the asset's going to be, who the players are going to be, and the participants in the marketplace, and then what the expectation is on the regulatory framework that they're going to be overseen under.
Understood. Thank you. I guess, Peter, let's come to you, because you have had a number of roles looking at the oversight of the system in various ways. What's your perspective on what's required here to oversee these new asset classes and the risk profile?
I think there are 2 points that I'd like to make right off out of the gate, as it were. The first point, which, although I agree pretty much with the laundry list that Tom gave us, there is a huge hole, and the huge hole is cost. The existing system is just too expensive. It produces rents for lots of interesting people around the place, but it's not necessary. That's a very, very, very important distinction that we really do need to bring out. And the second point, which is extraordinarily important, it seems to me, is that there are a distinction to be made between what we all do as wholesale actors in the marketplace, large bank to large bank, large exchange to large asset manager via large broker dealer, and what happens at a personal level. So I think to try and separate those two things out is extraordinarily important, because things around privacy for retail investors are obviously different than they are around for, the professional investors. Those are different things. So let's be clear that what we're talking about here, and I would say we should be talking about, is actually what goes on in the wholesale markets. Retail markets will, of course, look after themselves, and regulators will be incredibly important in doing that. But effectively, what we have at the moment is capacity for innovation to lower costs. And what we know from history is that when innovation lowers costs, what happens to volumes? Volumes go up, and when volumes go up, prices get finer, and investor opportunities multiply concomitantly. So it's very important to think about cost, and it's very important to think about innovation. Thank you, PJ.
No, pleasure, Peter. And thank you for bringing up the wholesale. I think, at least here in the UK, it's felt like there's been a lot of emphasis on retail, especially with the central bank digital currency. But there do seem to be policy avenues where they're beginning to explore wholesale. The recent Lords report, even though the title was misleading, actually, when you read it, seemed to actually say wholesale was something we need to be moving to. But that gets all tied up with real-time gross settlement and a lot of the infrastructure changes that are happening today. Do you see that the wholesale actually has a pathway, an on-ramp into the whole discussion about risk management?
Yes, absolutely. I mean, the wholesale debate with RTGS and a real-time CBDC type offering, effectively, you won't need an RTGS system, in my opinion, if we were able to deploy a properly engineered CBDC. The opportunity for financial institutions to be able to deploy collateral and to achieve settlement finality at the point of trade is obviously very, very attractive. Now, I do think that the focus on CBDC from a retail point of view is driven entirely by, shall we say, central bankers who want to appear cool and follow Facebook. I don't think that that's important in terms of overall financial flows in the wholesale markets. So I'm a very, very big believer that this technology will just sort of leapfrog the RTGS system almost entirely. We've seen that happen in other areas. And it's kind of like going from sending telexes and telegrams to people to using mobile phones. It's that sort of leap, I see.
I might think of a central banker listening to this right now that might have sweat on their upper lip, though, because RTGS is the essence of some of the risk management, especially for wholesale. And there's been a multi-year campaign to upgrade it. And you're saying, oh my God, we can leapfrog it. What does that mean?
Well, I mean, I think it's very clear. I mean, in a sense, you know, you kind of wouldn't ask the wooden navy what their views on submarines were. You know, the technology has moved on. You don't need to do things in the way that they were done previously, notwithstanding that you've got this multi-year program all over the world to replace these systems. I think it's perfectly possible to envisage a place where settlement finality can be achieved using a central bank digital currency. Now, that can work alongside an RTGS system if people don't want to get rid of what they've already invested in. But you know, really, it's a little bit like inventing the automobile, but deciding that because it might scare the horses, you're going to have a man with a red flag walk in front of it.
Interesting. So it becomes at the end of the day a very political question because it may not be addressed by the central banks.
Yes, it becomes a political question, but you know, of course, with everything that's going on in the world today, it also becomes a highly important security question because of the need and requirement to be able to enforce or at least have some opportunity of being able to effectively enforce sanctions. Very, very easy to do with a central bank digital currency, as what's been going on in the last 2 weeks regrettably shows, much more difficult to do using TradFi type rails. But you know, that I think is going to happen. I see certainly, you know, other jurisdictions, possibly less democratic than the West, are you know, really going to town on being able to deliver a central bank digital currency. When that is delivered, you know, it's up to the West to catch up. Well, if we're not already there with an offering, there's not much chance of us catching up. So what will we have to do? We'll be standard takers, not standard setters. And when you become a standard taker, you are inevitably less strong and more vulnerable. So I think there's a lot at play here, and CBDC, surprisingly, in my view, is right at the heart of this.
That's fascinating. Thank you for putting that in a very real context for us, because I think that these are very fundamental political footballs at the minute. Dan, let's drag you in here. I mean, you've had such a great ride with Securrency, talking about the the compliance oracle in the role that can play in a truly digital native format. How do you look at the need to think about dual control systems and how you join TradFi and digital rails?
Yeah, boy, it's tough to follow Peter, because I think you nailed it on so many points, Peter, with respect to cost. But let me start by saying, again, to really emphasize the power of blockchain, which is an immutable ledger that emphasizes specifically reconciliation. So the strength with global clearing, instantaneous global clearing, is of course the reconciliation power of blockchain. But the same thing's true for data management. And this allows you to manage data across organizational boundaries properly, such that you can make instantaneous, real-time, for example, pre-trade compliance decisions that are both automated and easy to oversee from a regulatory perspective. The two biggest cost drivers in banking are the cost of compliance, estimated close to $300 billion a year for systems, and then another $300 billion for fines for now not being in compliance. The second biggest cost driver is the middle office, and we're going to talk about the impact of blockchain on both of those. But it's important to break the problem down into two parts. Number one is the impact of crypto assets or blockchain-based assets on TradFi rails and how you reconcile. And then the second is the impact of traditional assets on blockchain rails. And it's important because many folks don't realize the difference between those two. So let's highlight the first category. It's important if you're doing banking services and working with crypto assets that you can do source of funds assessments. So you need to know where the value is coming from and that it hasn't been involved in bad activity. Well, guess what? That's actually easier to do on blockchain rails, because every movement of the value is immutable, and they're great tools to give you a real-time risk score for the whole transition of value. Another big challenge for banks is, as Tom pointed out, the interoperability challenge. It's hard for them actually to operate across these rails with the same and blend that data with their traditional rails. And that has an impact in terms of asset volatility, asset custody, as folks need to be sure that their value is safe. And any assets that are being held that have that kind of volatility, which are used as collateral, among other things, in the middle office, has an impact. So these are the kinds of things that banks are struggling to keep up with currently to match the huge demand from investors for assets in the blockchain space. Flipping it, and not to go too long, to address the cost factor that Peter brought up, that's traditional assets on blockchain rails. I'm going to give you a real world scenario of folks who are doing mortgage processing. They bundle mortgages into warehouses, and then from the warehouse, they take those financial instruments with QSIPs in the US. They use those as collateral for borrowing against other assets. Well, when the payments get made, which were originated through a bunch of different systems, then held by a party, used as collateral by another party in a different bank, wending that dollar flow to the rightful owner is a process that takes about 30 days. Well, there's enormous expense in that cost, but also on the cost of the availability of that value, that money in that flow. With blockchain, those flows, the ability to automate collateral and UMR requirements, actually through smart contracts, has a massive impact on the middle office, making those transactions of the payments of dollars or euro completely automated, but even more so, the measurement of encumbrance and margin requirements can be automated. So these are huge cost drivers that are coming.
Some great examples there, and I guess just to emphasize it, though, that middle office cost bucket is a big part of the equation in addition to the technology. To do that, you need the smart contract. You need to have the common standard that you can exchange. And is that, do you see that as a something that's getting easier with the adoptions of things like the common domain model and other industry efforts, or is it still kind of not there yet?
No, the industry efforts to develop standards have a massive impact. So ISDA, CSA models, has a big impact on the management of collateral. It's in terms of the way that we talk about collateral. But that then gets implemented in a bunch of different systems, in a bunch of different banks, in a way where we have to reconcile, did what you say match with what I say? And this, in terms of securities clearing, is a T+2 type of challenge. In terms of other kinds of private securities debt instruments, it's a T+30 type of challenge. Blockchain, again, let's go back to the core strength, is about reconciliation. That's what the whole breakthrough of the model is. So we can completely address those challenges by taking ISDA, CSAs, credit support annexes, and automating them on chain with smart contract logic. And you can revolutionize the way that banks operate around collateral, for example.
Got it. And I guess that's at the end of the day, that's the nub of it. It's not just what are we talking about and how do the lawyers write it up, because you can get that a lot more standardized, but it's how do you push it around and how do you then observe where the risk is. So Alex, I want to come to you because you're the big picture risk guy here. Well, how do you see the interoperability between these rails and how you get a better picture of the risk in the system?
Yeah. Getting a little bit nervous now because I may step back a little bit and talk a little bit more old school and then before we get excited about digital transformation, digital assets, and blockchain and all this new technology we are having here. But again, maybe a little bit old school as a start. In Europe, we have a lot of small, medium enterprise companies. They're running the economy here. To a large extent. We have a lot of small regional banks which provide the liquidity to these small, medium enterprises. And then we have a regulator who puts liquidity charges, capital charges, and all of this on the banks and the financial system itself. I think that the system is of course a rigid one, but it is there, and we have to comply with this. Now let's say we want to transform, we want to go on the technology side and into digital transformation. On the other side, with these new banking accords going into more green investments, going into more ESG investments. And so now the question is, how can we do this? And is that a technology which really can help this kind of transition? Because what do we need? We need data, because we still need to assess risk. We need to be open about the data and show this on the one side to the banks which are providing liquidity, but also on the other side, as we heard before, to the investors which might be a retail investor and wants to invest into loan portfolios, as you said, then in a securitized way. Yeah, and that's for sure the interesting thing. So from my point of view, we have still an old school banking system, with a small and medium price enterprises in the European markets. We need to have enough liquidity to refinance this. We are on the verge to say we want to transfer traditional investments into green investments, but we need to have enough data which justifies and describes these new types of investments in a good enough way. And ESMA said also in 2016 that securitization is a good way to diverse and manage risk and put liquidity into the capital markets. Now, would blockchain be the mean of technology which can provide the appropriate means to do the new way of refinancing our economy? Hopefully, yes, but I think that still needs to be proven.
Right, and so you're highlighting that the system in itself is relatively inefficient, and there's a lot of data out there that needs to be brought together. What do you see as the connection between the assets and the underlines? So the digital assets, a lot of them have underlines that are in the traditional finance world as a security. how do you need to think about that data set, and what really matters then in terms of bringing that together to the point of risk manager to understand the real risk, the real portfolio of risk that they're managing?
Yeah, as a risk manager, you need a liquid market, which means you need a price. Yeah, and you have traditional, you have equities traded on markets. Yes, they have a price. Yes, they have a daily price. Yes, I can have a spread model to assess the risk. Easy. Yeah, banks have huge loan portfolios. How do I put a loan portfolio into liquid assets which I can trade maybe on a blockchain? Yeah, we do have a blockchain. We do have a digital exchange in SIX. How do I make this a liquid product which is traded on an exchange? I think this is the interesting question which is coming up. And do I have enough data to describe the risk, to price such an instrument? Yeah, and then when I have enough price, do I have enough liquidity, being able to trade it? And once I have a liquid market, then I would say typical risk management processes and questions will be answered by itself, because, as I said, you have a marketplace, you will have the data, you will have a price, you will have investors, you will be able to exchange this. Instead of buy and hold portfolio, you will have trading a buy and sell portfolio. You may even have retail investors being able to trade into securitized loan portfolios. Yeah. So I definitely think we're going this direction, but we're still far away too, in the same sense.
Right. Well, we're a lot closer than we once were, because we're at least talking about a potential way to get more liquidity into the system by bringing those investors in, right? And that then helps with the innovation that could help transform the marketplace.
Yeah. But you have to. Yeah, you have to, because from banks have liquidity and capital charges. If they want to transform their balance sheets into, let's say, a greener balance sheet, yeah, they need to find ways how the assets get more liquid and tradable over exchanges. I think that's the way they need to go. Yeah, which also means that maybe the traditional lending business will change. We will see more securitizations. Hopefully, blockchain will help us share the data and get more investors on an exchange, but we're still far away from that. Let's be honest.
Yeah. Thank you, gentlemen. That's a fantastic canter through a number of opportunities, but also risks that we're facing right now. Tom, I want to circle back with you on our final question, which is pretty straightforward, but there's a lot of nuance here. So the question is, why should people listening to this dial in to the 5th of April event? In other words, what's real and what matters to them? And I wondered if you could address, as the head of innovation, like how close is some of this to actually hitting the real-time desk the manager's desks as something that they should be considering, or is it just something off in the ether?
I mean, I think to specifically answer your question and why participate now is this absolutely fascinating time in finance, and it might be something that defines a person's career. It might be a very special moment, because I mean, there's virtually no area of financial services and market infrastructure that's going to go untouched with digital assets and the transformation that's happening now. I think there's great opportunities to think well beyond the technology. A lot of times we kind of jump right into the implementation of the technology and to look at a kind of holistic view on what's changing out there. So it's not just the technology, it's legal frameworks, it's definition for assets, it's some of the things that the other people on this panel have spoken about. I think that there's also a chance to talk about how do we really create additional business value, as opposed to just doing the same thing we already do with traditional finance using different technology. That doesn't excite me at all. That doesn't interest me. We don't do any of that because it doesn't help move the needle at all. I mean, I think this has been mentioned a couple of times today that lower costs are really based on standardization and automation, whether that's through a smart contract or something else. But that's really how you're going to get lower cost for the industry. In addition to actually achieve the lower cost, you need a path to production. So yes, this is happening today. Some of these things will take longer, take a longer runway to come to fruition, but it's happening now. It's happening today. And kind of the fear of missing out should be real. If you're not plugged in, you don't see what's happening. this is something that's going to pass you by pretty quickly, and you're going to be left fairly unprepared.
Yeah, amen. I struggle to explain to people that didn't live through Dodd-Frank what it means when the U.S. says 180 days we're going to be there, because the mother of all RFPs has now gone out, and there will be trees slaughtered in the name of, we're defining what the U.S. market's going to be about. But as Peter says, there's lots of political pressures. There's plenty of other people moving. We got Europe, we got the UK. But when the U.S. says 180 days, they will define a path forward, this year. Whether they get the implementation detail, don't know, but there'll be a lot of good detail buried in this stuff. And I think you're absolutely right. If you don't kind of wake up, at least tune in a little bit this year, you're going to miss out.
Yeah, and innovation comes in big and small, right? What you're talking about here is, could be a fairly big shift in financial services globally. But there's a lot of smaller things too. Everything isn't a ta-da moment. So innovation's happening everywhere, all over the place, big and small. I mean, I look at, there's a consultation paper coming out about the next generation of RTGSs from the Bank of England shortly, right? Those could have very significant impacts on how business is done today, but also be a good leading indicator in terms of where we're going. Do blockchains coexist with RTGSs? RTGS plus, we're not sure. But if you're not in that conversation now, you're going to miss out because it's moving fast.
Thank you, Peter. Excellently put. Same question for you. What do you see as the big pressure points that people ought to be understanding right now?
I think some of the work that I know is going on now, for example, the regulated liability network stuff that's coming out of a number of institutions, which manages to keep the internal integrity of a bank's balance sheet intact and allow it, therefore, to be able to produce private money as well as use public money, which is incredibly important in terms of the credit process. I think that those type of things enabled by forward-looking central banks and enabled by a digital network that will be very different from the ones that we use at the moment in terms of hub and spoke type applications, but will be much, much more a diversified network. I think those sorts of things are going to produce some very, very real changes. I know that there are lots of people are doing work in this space, and I'm very sure that the reason that people should be tuning into this is that they will be ahead of the thinking. They will be part of the team that are providing the answers, not being part of the team that are asking the questions.
Very, very well put, and great follow-up. Dan, I'd like to come to you next. There's a lot of things just below the surface people have been hinting at today, but what is it that you would throw out there to encourage people to join us for the next discussion?
So I think there's a false sense of security amongst folks that they have time before this comes to pass. Our customers are major strategic financial institutions, global financial institutions, and I can tell you that there's very active work that is transformative that is taking place there. In some cases, it's already live. But take, for example, one of our customers, WisdomTree, a large independent asset manager in the space. They're releasing here this year and actually imminently using blockchain technologies, direct-to-customer asset management. So imagine ETFs or mutual funds in any case that can cut out all the middlemen and allow folks to blend, skip the wholesale market and to go direct with strategic value to end users and customers. We have sovereign funds as partners and investors who are looking for the same thing. Imagine allowing your citizens to invest directly in the uptake of sovereign funds. And then again, the ability to automate, as we've said, back and middle office functions to get the kind of liquidity that Alexander was talking about. Our strategic partners are working exactly on those problems to allow them to take their balance sheet and make it liquid and effectively better manage their risk. So these things are quite real, quite near term. To the extent that these roll out and you get the full regulatory approval in 180 days of these type of models, which I think is optimistic, but in any case, you suddenly have a very different financial landscape with a different cost point. So tune in and hear how this develops.
Great point. I think you're absolutely right to be highlighting. I see more and more quarterly reports coming out from big players like the Wisdom Trees saying they are actually moving this way and they got things to show. So, I mean, congratulations to you and the team for getting folks there. Alex, we get the final word coming to you. Why can't people afford to miss the next discussion?
I start with the quote, or I start with Tom's quote, and I agree with you. And we are not doing innovation in order to do traditional business with new technology. We want to do new business in a new way. And of course, we need to keep the integrity of a bank's balance sheet. Completely agree with you, Peter. But I'm really with you, Dan, when we are saying, how do we transform a market? How do we ensure that an investor, also a retail investor, has enough data and enough confidence to invest into, let's say, into a simple bank loan and directly invest into a kind of local economy, and profit from a simpler process which is driven by innovation. And then on top of this, being able to have new products, shall it be ETFs as we speak today, or digital XXX products as we will see in the future, but everything based on open data you have, where you know what you're investing in, and a simple process which enables you to relatively simply invest into the economy. Shall it be your sovereign, your community, your local, whatever SME provider. I think this is the way we are going, or we shall go, and innovation should help us in that space.
Thank you, Alex. And I do appreciate also the earlier shout out to ESG in the green funds, because this isn't the only thing going on right now. There are so many changes out there driving people to talk about this. But yeah, I kind of go back. I put myself in a state of mind where maybe I was under 30, and I can sort of listen to these older guys telling me, no, it's all different now, or this is all really important. You should pay attention. And I'm probably going, well, yeah, maybe we'll see. But I think a lot of this gets down to showing people it's real, and so much what you guys have brought to life here really does help bring that to the forefront. And so I think that's to me the key thing is come work out what's real for you, because there's so much in here. As Tom mentioned, it doesn't have to be a really big thing. It could be one little consultation paper, and you don't want to miss it because, or you could also be missing out. You don't work a Wisdom Tree, and you just found out they're doing something. Take that back to the management team. So all kinds of reasons to get engaged now, big picture as well as very personal, real, and at home. So I thank you all, gentlemen, for helping to bring that to life. And I'm really, really looking forward to April 5th. Just as a quick plug, I'm also launched today a LinkedIn newsletter at quarter to 8 this morning. It was live. Last time I checked, it had 780 subscribers. So I think that's something that you got to take in mind today in terms of getting the word out. But please subscribe to PJ's newsletter is now the new ask. That's not going to be on the recorded thing that you hear. If you want to find out more, check out the show notes or go to our website, jwg-it.eu, and find your way to the conference. But that's all for me for now. Look forward to speaking again soon. Gentlemen, thanks very much for your participation.
Thank you. Bye-bye.
You can download the podcast via Spotify, Apple, and Google. But also, I'd encourage people to come to the JWG website, which, as hopefully you will know, is jwg-it.eu. Go to the Intelligence Hub and create your bespoke library. This is RegCast,
shining a light on challenges and opportunities for digital compliance.